Welcome to the Trading with Venus podcast. I'm your host, Raman Gill. Last week, I did a webinar for Vantage FX that I would like to share with you. In this webinar, I talked about market correlations. So, market correlations means different securities that move together. And today, with what's going on in the market, the correlations become very, very important. So, if you are interested in knowing how to trade Forex by looking at what else is going on in the market and being more aware of the market, this is the webinar that you want to listen to. Now, if you would like to see the slides, I have this on YouTube as well, or of course, you can listen to it on podcast. To get to the YouTube channel, please do a search for Trading with Venus and you'll be able to see this video on the YouTube. Enjoy.
Good morning or good evening, ladies and gentlemen. My name is Lily. This webinar will be starting in the next 1 minute, so we are just waiting for some of the other attendees to join us. In the meantime, please do have a quick look on the disclaimer on the screen. We're just waiting for 1 more minute. Thank you. Great, let's get started. Again, good morning or good evening to you, everyone, ladies and gentlemen. My name is Lily, and I'm from Vantage FX. Today is our honor to have Roma, who is has been trading forex for over 10 years, and she used to work for one of the largest financial industry in North America in North America. She has also has her own YouTube channel, Trading with Venice, which she used to help new trader to understand the market a bit better. And like what made me really jealous is she actually has two MBA degrees. So it is our great honor to have her to share her trading knowledge with everyone. For everyone that who just joined us, it is our pleasure to have you here. So during the webinar, there is a questions function on the go to webinar panel, so you can shoot down any questions there, and we will get to that by the end of the webinar. But we also have a quick Q&A session, like towards the last 5 to 10 minutes. So if you have any question, you can also save it till the end. Let's get started. I will pass the mic to Ramas today. Thank you.
Welcome everyone. Thank you for joining me today. And if you're joining me really late, thank you for taking the time out of your evening to be here today. Today, we'll talk about how to profit from market correlations. So you must have seen what's going on in the markets right now. We seem to have extremely high volatility, and market has been flipping back and forth. And many times I get questions from traders asking me, well, the price was at this support and resistance level. What happened? Why did it shoot up very quickly? And if you are watching the screens right now, you know that the yen crosses just dropped. So this is the type of stuff that we see all the time. Price just takes off and for no apparent reason. So today we'll talk about what is going on in the market, and we are looking at something that's outside of technical analysis. So what else is driving the market prices? And in that regard, it's very important for us to understand what is going on to get an overall view of the market. So today we will talk about market correlations. So what exactly are market correlations, and how do these correlations impact our Forex trading? And also, now that once we understand what the intermarket correlations are, how do we then use these to our benefit so that we actually are more successful in our Forex trading? So at the end of it, we do go back to Forex trading because I am a Forex trader, and my focus is mostly on the Forex market, even though we will talk about a lot of other stuff. A little bit about myself. I am a Forex trader. Like Liz said, I've been trading for over 10 years. My educational background is I started off in IT. I have spent over 18 years in IT. And then I went into mergers and acquisitions. And I worked in the bank for a number of years after I sold my IT consulting business. And of course, like everyone else, I have other stuff going on. The role of trading in our life has to be to support our lifestyle, and so that we can have more freedom in our life. So this is what we focus on, or we need to focus on, not so that we just sit there and stare at the screen. So I'm of course a mother and a wife, so there's a lot of stuff going on. I have two young children, so it is a busy, busy life. All right, so let's get into it now. What is market correlation? Market correlation basically means that there are two different securities that move together in relation to one another. So when we look at Forex, generally we just focus on our currencies, but then our currencies are not trading in vacuum. There are other things that are related to this. For example, oil. Oil moves with the currency market, or currency market moves with the oil market. And then there's also gold. So we'll talk about these. But the bottom line is market correlation means how the two different markets or two different asset classes are related to each other, and how do they impact each other or move together with each other, whether they move in the same direction or they move in the opposite direction. So first thing, actually, before we go into interest rate, so just on the market correlation point, now there are two different types of market correlations. One is your straightforward correlation, where two asset classes will move in the same direction. And that is the case for Canadian dollar and oil, which we'll get into in a little bit here. And then we have the opposite, where two asset classes will move in opposite direction of each other. So for example, the stock market, and we have Japanese yen, for example. So Japanese yen is safe haven. It will move in the opposite direction of the stock market. So if you take a look at your charts right now, I don't have the charts in front of me. I just have the yen, one of the pound yen that I'm looking at. Pound yen dropped, so I can say that the stock market must have dropped, because stock market is it has a reciprocal relationship with Japanese yen. So they can be two different relationships. They can move in the same direction or in opposite direction. All right, so let's take a look at interest rates. Over the last little while here, since the beginning of this year, you would have noticed that central banks have been at it all year. Sorry, yeah, all of 2020. This year has been crazy from the very beginning in terms of what's going on around the world, and also what's going on in the market. So there has been a lot of focus on interest rate. So why do we need to care about interest rate as Forex traders? And the reason behind that is because interest rates are directly correlated to what happens with the currency. When today we had Bank of England rate decision. So when Bank of England cuts rate, for example, the currency will then drop as a result of that. So when the interest rates move up, the currency will move up. When the interest rates are cut, the currency will actually drop. So overall, these two are very tightly correlated. And why is currency so tied into interest rates? The reason for that is because interest rates will dictate the flow of the global capital in or out of a country. So for example, let's say we're talking about Australia. Australia has in the past, they have had higher interest rates. So when Australia offers higher interest rate, more investors want to invest in Australia, because the return that they would get in on their capital would be higher than what they would get elsewhere. So more investors would then have to buy Australian dollars in order to buy Australian securities or to invest in Australian market. And as a result of that buying, Australian dollar will go up. And same applies to yen, for example. Yen is known to be a carry trade. Uh, Actually, so in the carry trade strategy, what happens is we're looking at two different countries with their interest rates. So this is called interest rate differential, the difference between interest rate of one country versus another. So in the in the carry trade strategy, and this is a strategy that a lot of large financial institutions and large hedge funds and so forth will apply. So basically, what they're doing is they will take a lower yielding currency, so the currency where you do not get a lot of interest rate. So, for example, Japanese yen, where the interest rate is negative. So there is no point in putting your money in a bank in Japan because you're really not making anything. Really, you're losing money because not only is the interest rates negative, you're actually having to pay fees to keep your money for the with the bank. So it doesn't make sense for all these big corporations or big funds to have the money in Japanese yen. So what they would do is they would actually borrow money from Japan. So they will take the money to get a loan from a bank in Japan. So they're getting it at a really low interest rate. So even though the central bank interest rate, Bank of Japan rate is negative, the regular banks won't actually lend at that rate, but the interest rate will be extremely low. So they will borrow money at this really low rate, and then they will go into US, for example, when US had higher interest rates. So they go into the US or Australia. Aussie yen was a big carry trade for a long time. So they would borrow money in Japanese yen and then they go invest it in Australia or in the US. And now their money actually even if they were to just put money in the bank, they would get better interest rates. But generally, what these large hedge funds and institutions do is they will actually then invest in the stock market so that the return on their money is way higher, because as the stock market goes up, because more investors are coming into the country, plus the domestic investors investing in that market pushes the stock market up. And then as a result of that, you get better returns than what you would get on bonds and other things like that. So that's called the carry trade, where you borrow money in a currency that has really low interest and put it into a country where the interest rate is higher. But what happens is, in order to invest in that country, you have to buy the dollars like we talked about. So you would borrow in Japanese yen, but then you would have to convert the yen into US dollars. And when you're doing millions and billions of those, that is going to push the market higher. So you will see that US dollar goes up or Australian dollar goes up. So Aussie yen will go up and a dollar yen will go up. So that's why we see that. So you could just leave your money in there in that trade. So you could do Aussie yen, for example, not right now, but in general, when we're talking about carry trade, so you would just put the money in Aussie yen and you would just let it run. That's it. And you will see that Australian dollar will Aussie yen will keep going up. So whatever money you put in that, the return would be really high because of that strategy. Now, in the beginning of this pandemic, when we started seeing so back in February, March, when the market dropped, we saw an unwinding of this carry trade. So actually, euro yen was an example, or euro dollar was also an example where with euro paying zero interest rate, so there was no point in investing in euro or leaving your money in the euro. So people would, again, the big funds would borrow the money in from European countries, so in euros, and then convert those euros into US dollar. So in the beginning, we saw that euro dollar went up as a result of that when everything else was dropping, and it was a little bit baffling as to why euro was going up, because it was the unwinding of the carry trade where people were pulling money out of US dollar and they were going back in euros because both of the countries interest rates were low now. US had aggressively cut their interest rate, so they went from 1.75 to 0.25, and as a result, so there's no point in having the money in the US. Might as well get it back, because at 0.25 there isn't much difference between 0 and 0.25. So we saw this unwinding of the carry trade where people were selling the US dollar and converting it back into euros, and euro dollar was going up as a result. So this is how it plays a role in our trading, because in order to understand why that was happening when everything else was dropping, it was the unwinding of the carry trade. Okay, so next thing that we will talk about is oil. We have also seen a lot of fluctuations in oil. You may recall at one point this year, oil was actually negative. So they were actually paying you to take oil off of their hands, which sounds really bizarre. But that was what was happening with the oil futures. They were negative. So how does oil play a role in our Forex trading? So oil has a positive correlation with Canadian dollar. So positive correlation is, like I mentioned, when two securities move in the same direction. So in this case, Canadian dollar and oil. So I live in oil country here in Canada. So this is something that has a big impact on everything around me. Unfortunately, we are still heavily tied into oil here. So when oil dropped, there was a lot of concern in regards to Canadian dollar. There was a lot of concern in regards to economy because that was the big industry here where I am. So if you take a look at correlation between oil and US dollar, actually, so oil and going back to here, oil and Canadian dollar are positively correlated, which means that when oil price drops, Canadian dollar will drop. And when oil price goes up, Canadian dollar will go up. So if you take a look at this chart, it's a little bit older chart, but just to show the relationship in the past, there are times when the relationship will break, but for the most part, these relationships do tend to stay over the long period of time. So we saw that so when we say Canadian dollar is directly related to oil, that means dollar CAD has the opposite relationship to oil. So when oil drops, dollar CAD goes up because US dollar is the first currency in that pair, and the move is dictated by the first currency. So Canadian dollar goes down, that's why dollar CAD goes up. When oil goes up, and we see that dollar CAD goes down because now Canadian dollar is stronger and US dollar is weaker. So they have the opposite relationship. So if you take a look at dollar CAD, we see that when oil is going up, dollar CAD goes down. And of course, when we have some unexpected stuff happen, like we saw 9/11 in this here, so that kind of stuff can go out of whack. But over periods of time, that kind of stuff can go out of whack here as well. So sorry, this was not 9/11. This was the big financial crash here. Actually, yeah, that's why I wanted to make sure we touch on this chart, because in the financial crash, we saw that oil prices went through the roof here, and then subsequently they dropped. So in this case, the relationship may not always be as strong, because this fluctuation here in oil going up and during the financial crash was not as bad as dollar CAD dropping, because US dollar is a safe haven currency. So when we are going through crazy times like we are right now, US dollar tends to do well. And when the stock market start to go back up, the safe havens assets don't do as well, which US dollar is part of. So now in the recent weeks, we have been seeing our stock markets, all our indices have been going up, and we have seen that US dollar or the safe haven currencies have not done as well. But there is a positive correlation. So when we saw that it went back in, so oil was going up, dollar CAD was dropping again. So just remember that oil and Canadian dollar will move in the same direction, which means oil and dollar CAD will move in the opposite direction. So taking a look at our chart here, what you can do is, if you're on TradingView, you can overlay two charts. Or if you're using MT4, what you would do is you would just have your two charts open. You will have your dollar CAD, and then you'll have your oil chart open. So when you see the oil actually starts to go up, you will see that dollar CAD will start to go down. And this is where you can trade your technicals, but keeping in mind your market correlation. So when oil is going up, just notice that your dollar CAD will go down. And this is where, as soon as that flips, you can take a trade here as well. So that's why I do my market analysis every day. So if you can go to my YouTube channel and check that out, I post it. But I tend to cover all the different markets because they are so correlated, and I have started doing that because as soon as you look at two different things, once you start looking at it over time, you get good at it. Then you don't have to pay that much attention in the sense of having to learn or remember things. You will just keep it will be in your mind, so you will just have those charts on your screen, and you can flip back and forth with them, or you can just do trading view and chart them, two of them together, so that it will remind you of the relationship, and you will be able to see when the market changes, so that you can then change or you can then take that trade. But these trades can be quite they can be quite profitable, actually. Okay, so let's take a look at gold now. Gold is another thing that has a correlation. Now, this time the correlation is with Australian dollar. So gold and Australian dollar are positively correlated. Now, with this one, though, I would say one of the things that's been happening lately is this relationship is a little bit out of whack. So gold is a safe haven asset as well. So safe haven assets are the ones that go that do well in risk off mode. So risk off mode is when investors are not willing to take risk, and risk on mode is when investors are willing to take risk. So lately, if you take a look at the stock market, it has been in a risk on mode, and you must have heard about a lot of Robinhood traders, a lot of people going into the stock market and buying stocks. And as a result of that, the market has gone up, or I should say the market has gone up, more people joined, which pushed the market even higher. So it has been very much optimistic view in the market, this positive sentiment in the market, and I'm talking about stock market. And as a result of that, it has gone up. So that has a opposite relationship with safe haven assets. So that is called risk on mode. Under those circumstances, you will see that Japanese yen will drop, Swiss franc will drop, and usually US dollar will drop, which means our dollar crosses are going up, our Swiss crosses are going up. So we saw that Euro Swiss took off, and then also our yen crosses will actually go up. Over the last few days, since last Thursday, we are kind of dealing with this a bit of a flux of risk on, risk off, risk on, risk off. So the market can't decide what sentiment it has in the market. And that is tied into what's going on in the world right now. We are seeing a second wave of COVID-19. We have seen Japan, China is shutting down parts of Beijing. Some or schools have been shut down in Beijing because the virus is spreading once again. In the US, we are seeing a lot more cases of COVID-19 in Florida and in Texas. And as these states are opening up, we are seeing more of these cases. So that is weighing on the market, and the market doesn't like risk, actually. So when these problems happen, now we saw last week, Thursday, I believe it was, when the stock market started to turn. And with that, our yen crosses started dropping as well. Today, the mood is soft in the market right now, and we have seen the yen crosses kind of holding overnight, but this morning they dropped, which if you are in UK, it will be evening for you, or in Australia, it will be evening for you. But we have seen that these are going back and forth, and this is directly related to the stock market, which we'll talk in a bit. But gold is a safe haven asset, which means that it tends to move in the opposite direction as the stock market. However, lately with the pandemic is something that happens once every 100 years or so, and now the relationship with gold is not as tight. But if you look at some of the reports that the big banks are putting out in terms of their long-term view on gold, they are saying that gold is likely to hold its value, and a lot of that has to do with inflation, which we won't get into that. but generally we see that gold tends to do well during uncertain times. But you may have noticed when the stock market started dropping, gold dropped as well. But that was because a lot of people were getting margin calls and stuff, so they just had to sell whatever they had, including gold that they were holding, in order to cover their market requirements. So just understand that right now the relationship may be a little bit off because of unprecedented times. But Australian dollar and gold generally are positively correlated. So if you were to lay the two charts together, you will notice that as our gold drops, you will see Australian dollar follow very closely as well. And there will be times when the relationship breaks like this one, and that's only for a short period of time, then it gets back on track. But Australian dollar and gold are they are very tightly related to each other. And the reason for that is, if you just think about it, it's because Australia is a big producer of gold. It is one of the exports, one of the big exports that Australia has, together with things like copper and iron and other things like that. Same with Canada. The reason Canadian dollar is so closely tied into oil is because oil is a big export for Canada. And if oil drops, then Canadian dollar drops, because that means that the country or the economy won't do as well, and hence the relationship. So just remember, Australian dollar, gold are together. And because Australian dollar is the first currency in the pair here, then that's why they move in the same direction. Whereas we saw that dollar CAD and oil moved in opposite direction, because here US dollar was the first currency, the base currency, and then Canadian dollar was the second one. This is why the relationship was opposite when we drew the chart. With this one, it's the same, because Australian dollar is first, and then it just moves in the same direction here. So if you take a look at this chart, we see that they're both moving in the same direction here. So they are all nicely tied up together. Okay, so one of the things that you will also notice is gold and US dollar actually tend to move in the opposite direction. So they have an inverse correlation with each other. So when gold goes up, US dollar goes down, but then gold is also priced in US dollar. So it's used as an inflation hedge, which means that some people, when they're concerned about the strength of the US dollar, you can buy gold, because if US dollar drops, your price of gold is going up, and you end up at break even. So you still maintain the strength of your currency. And this will become something that we'll have to keep in mind down the road here, because of the immense amount of money the US Fed is putting into the market right now. They are buying everything on the market. They're buying our, what do you call it, bonds. They're buying corporate bonds now. They were buying treasuries before. They're going to start giving money to nonprofits. So they're basically in the market buying everything up, and they have bottomless uh, bank account. Essentially, they said they would just spend as much money as is needed, which supports the markets. But in the long run, what happens is, when you have oversupply of something, the value of that currency goes down. And this is why the gold price is likely to go up in the future. So if you look at about a year from now, or 6 months down the road, the gold price is likely to go up, and the US dollar is likely to drop because of too much oversupply of US dollars. But then gold, because gold is inversely related, we are likely to see gold go up. So actually, before we jump into the next session, any questions here? So just popping up these questions, could you just go through the risk on and risk off again? For sure. Okay, so risk on mode is when people want to take on risk. So if you take a look at our stock market, you will notice, actually, let me see if I can pull up my chart here. So here's our Nikkei. So let's take a look at S&P 500, or not. S&P 500 is good. Okay, so if you take a look at the S&P 500 here, you will notice that market has been going up. So this is our stock market. It has been going up, and this is called risk on mode when the stock market is going up, which means that investors are willing to invest their money into risky assets, and stock market is considered a risky asset. So when they're willing to take risk, it's risk on. That means the stock market will go up. And if you take a look at this drop here, this is called risk off mode, which means the investors are concerned and they're not willing to take risks. So this is where everybody was selling all the stocks that they were holding, or stuff they were holding, securities they were holding, in order to get out of the market. So this is called risk off. They don't want risk, so they want to just sell their risky assets, because what happens is when there is fear in the market, we tend to go into the risk off mode, right? And this is risk on right now. Today though, so this is the daily chart. So if you take a look at the hourly chart, for example, we see that it has been dropping because we are going into the risk off mode. This is what I was saying over the last few days. If we see that market has been slowly making its way down. So we have this downward trending market. So market is making lower highs, hasn't quite broken the support line. So it hasn't made lower lows yet, but it is making lower highs, and it is likely to drop from here. So once it breaks this support, it can go all the way back down here. But if it holds this support, it can go back up. So right now, we don't know which direction it wants to move in. All we know is right now it's slowly making its way down. And this is what I was saying. If you take a look at our pound yen, for example, that is dropping. So if you take a look at euro yen, that one is dropping as well. That's because, again, of the correlation. When the stock market drops, it's in risk off mode, we see our yen crosses will drop as well. So that's called risk off mode. Risk on is this here. When the stock market was going up, as we can see, the yen crosses are going up because investors want to take risk. So they take their money out of the safe haven assets, and then they will put money into the stock market. Does that make sense? Okay, so next question here is, does CAD follow the oil price after a certain time period, or do they move together at the same time? Usually they move together at the same time. So if you take a look at oil here, so this is the oil. Oil has been basically sideways here. So I don't have just the Canadian dollar chart here, but I do have dollar CAD. So here, if you take a look at it, it's been going sideways, right? Oil hasn't really done much over the last few days. Now, we were seeing oil drop, and then when our stock market was going up, oil went up. See how it dropped here? The reason oil dropped was because with all the economies being shut down, the demand for oil dropped substantially. And this is why we saw oil drop with the stock market. So if you take a look at it from January, so this is when China started shutting down, this is when oil started to drop. And because China is a big importer of oil, they use oil for all the factories, to run all the factories and so forth. And when that started happening, when the shutdown started happening, we saw that oil dropped. And if you take a look at dollar CAD, it should be moving in the opposite direction. So here we have dollar CAD. See how it shot up? Because it's inversely related with dollar CAD, with oil, because Canadian dollar and oil they're moving in the same direction. So when Canadian dollar, and if you take a look at it, this is where it started moving up in January, because all the news started coming out for coronavirus, and the market just took off. This is where there was that big gap in the stock market. It dropped down, and we see that dollar CAD moved up and our oil had dropped. So looking at the oil chart, so remember this, see how from January onwards dollar CAD is going up, and if you take a look at the oil chart here, we'll see that from January onwards here, we see that oil was dropping. And then when oil started going back in April here, you will also notice, if we go back to our dollar CAD chart, you will notice that this started coming back down, right? And now it's sideways. And as we can see from this chart here, price is just trading in this range at this point. So they are they're closely related. So dollar CAD and oil will move in the opposite direction. All right, so I think those are all the questions. So we'll get back into it. Okay, so we'll talk about stocks. Stock market, as we have seen recently, is very, very important. And when we see the moves in the stock market, we can actually take advantage of it by trading our Forex. So this is where today, in this volatile environment, it is very important to pay attention to what's going on in the overall market. So I always talk about this in regards to, for example, if you play sports. When you're playing sports, let's say I will talk about American football, but let's say you are playing football and you are a wide receiver. So that means your job is to run down the field and catch the ball when you're in position. Now, if, for example, your quarterback gets sacked, that means the defender comes and attacks him and basically flattens him on the field. You won't actually be able to catch the ball because there's no ball thrown, right? So not only do you need to make your cut and be in the right position to catch the ball, you also have to be paying attention to what's going on with your quarterback, because if your quarterback is sacked, there's no point in running, right? Or if there's another play going on, you still do your cut, but you won't be able to actually be in the play. So this is where it's very important when you're playing sports to have overall field awareness. You need to see or understand what's going on in the field, what's going on with other players on the field, because you have to make adjustments based on what's going on with other players. So if your quarterback is not able to throw the ball as far as you're running, maybe you need to adjust your cut and that type of stuff, right? So field awareness, overall field awareness is very important when you're playing any kind of field sports. So American football, rugby, soccer, whatever you may be playing. So in the same way here, when we are trading Forex, we are not the only participants in the market. That's why we have to be aware of what other participants in the market are doing so that we can either protect ourselves or take advantage of the situation. And this is something I have learned from the school of hard knocks, because this is something when we first start trading, this is not something we pay attention to. And I didn't really understand that till years down the road, because I used to really trade technicals, which I still do. As you've seen in my chart, there's all kinds of support resistance and stuff there. But being aware of what's going on in the market can actually support you in your trading. So let's take a look at stocks. So when the stock market is going up, you will notice that Australian dollar goes up, New Zealand dollar goes up, Euro yen goes up. So basically all yen crosses go up. And we see that dollar CAD goes down, Euro Aussie goes down, and pound Aussie goes down. So let's take a look at just these ones, just because they are easy and everybody trades these. So I said when stock market goes up, Aussie dollar goes up. So Aussie tends to be our risk currency with euro here. So if we go back to our charts here, let's take a look at the Aussie dollar chart, right? So you will notice in January here, January of 2020, December of 2019, see how Aussie dollar was dropping all the way into March of 2020. So if you take a look at our stock market, so this is Aussie US dollar daily chart. So if you take a look at our S&P 500, which is just a proxy for any market here. So if you go to the daily chart here, so see how we saw some concerns over here, but Chinese market started dropping in December. This is late December, early January is when China started shutting down. And we see that here, the US stock market for some time didn't really care about it because it hadn't really impacted the US. So if you were to take a look at Nikkei, it will probably be a better indicator, but we'll just stick with this for now because it's pretty much the same here. So in this case, we saw a little bit of time here. There was a lag because US wasn't impacted. But when the stock market started dropping here, as you see, we saw Australian dollar was also dropping. So Australian dollar is a risk currency, which means when it's a risk on environment, that means people are investing in the market, in the stock market, it will go up. And as we have seen since March, Australian dollar has been going up for the most part. And when the big crash happened here, Australian dollar dropped as well. So going back to our Aussie chart, just to show it to you again, see this big drop here? This was, and especially in March, this is where the floor fell off of the market. We saw Australian dollar drop, so Aussie dollar dropped. So, and one of the other things we talked about was New Zealand dollar. So if you see, it's a similar trajectory here. We saw in December, things started to soften. And the reason Australian dollar, New Zealand dollar started to react in December was because of, like I said, Chinese markets. Both Australia and New Zealand are big exporters to China. And when China starts to shut down, it will have a negative impact on Australia and New Zealand, so their currencies as well. And that's why when China does well, when the numbers out of China are coming out well, so PMI numbers, GDP numbers, when those numbers come out well out of China, we see that Australian dollar and New Zealand dollar do well as well. But in this case, when they started shutting down, so market went into risk off mode. We saw this drop, and then when market went back into risk on mode, which we were, see, this is where it really accelerated. The stock market was going up like crazy, and we see that Australian dollar and New Zealand dollar followed basically the same path. And if you take a look at euro yen, this was another thing we talked about. We have seen that price was dropping here in March. This is where it really dropped. It actually started in January here. This was a little bit more, euro was a little bit more volatile because I talked about how people were taking money and buying euros again. So it was, the carry trade was unfolding. So let's take a look at pound yen. Because this is smoother, because pound did not have that type of a move because interest rates were high. So anyway, so if you take a look at it in January here, so this is more correlated to the stock market, that the S&P 500 we saw. So we noticed that in February here, stock market in US wasn't really spooked. So this was going up. So stock market was going up. So we saw pound yen go up. And when stock market started turning, we see that pound yen started dropping. So this is all the yen crosses basically follow the same trajectory. When we are in risk off mode, that means the stock market is dropping. This is dropping here as well. And now that in the recent weeks, we have seen that stock market has been going up, pound yen went up as well. And today, we just saw that stock market is dropping, so pound yen is dropping as well. So if you take a look at what's going on in the stock market right now, so S&P 500, it is dropping a bit, right? And if you take a look at Dow Jones, that's dropping as well. NASDAQ is sort of hovering there. So we are seeing these currencies drop. So it's important for us to take a look at that. So going back to our slides here. So basically, just if you are watching the replay or if you want to go over this again, you can just take a snapshot of the screen and just remember when stock market goes up, Australian dollar goes up, New Zealand dollar goes up, Euro yen goes up, and these currencies will go down, and vice versa. When it drops, these will go in the opposite direction. So when stock market moves down, Australian dollar will drop, New Zealand dollar will drop, Euro yen will drop. So if you take a look at your charts, these will be dropping right now because the stock market today has been soft. It's been dropping a bit. So you'll see that these pairs have been dropping as well, and these tend to go up. Okay, so in terms of our correlations, we also have currency correlations. So in this case, we see that euro dollar and pound dollars are positively correlated. And then you have our mirrored pairs, which move in the opposite direction, is our dollar Swiss franc. And this is where when you have our dollar yen and dollar Swiss franc, they will move in the same direction, and they tend to have basically move in lockstep, whereas our Aussie dollar is a mirrored pair. It will move in the opposite direction. So so that's something to actually, sorry, no, Aussie dollar will also follow. Pound dollar and euro dollar, again, they're highly correlated. They will move together. and then we'll see Aussie yen mirrors that move. Sorry, not in the opposite direction. It will mirror that move as well. So those are the currency correlations. What I suggest right now, and again, these are my views, these are not Vantage views, is that to take a look at the stock market, right? Right now, everything is being driven by the stock market. So if you're trading Forex and you don't know why things are moving, I highly recommend putting a S&P 500 chart or any of the indices on your charts so that you can look at that. Even if you don't trade, I don't trade. I used to trade oil and gold. I don't anymore. I've been mainly focused on Forex, but it's good to have those charts so you can have a good idea of what's going on in the overall market, because it really will help with your trading. So that's just one of the recommendations. Because stock market is driving everything right now, the focus is so much on the stock market, with all the central banks just putting money in. Even today, Bank of England said that they're going to put an additional 100 billion, I believe it was, into the stock market. So that will generally pushes the stock market up, as the central banks are buying so much. So keep an eye on the stock market when it's soft, and we may go into that risk off mode. Again, nobody can really say with 100% certainty what's going to happen, but it looks like we may see a drop in the stock market. And if that happens, these are some of the currencies you want to be paying attention to, and these are correlated, so you'll be able to find a trade somewhere. And that brings me to the very end of our seminar here. Any other questions? Okay, so if the correlations happen at the same time, how do you know when to enter the trade? So the way I look at it is I will pay attention to both of them. So like I said, I don't trade the stock market, but I am currently short in pound yen, and that's why I was taking a look. I have it open on my phone here, and I'm short euro yen. So how did I enter that trade? Because what happened was we had this softness in the market, and market yesterday, for example, this is how I do this. Yesterday we had a pin bar in our S&P 500, right? So now I go over to our, let's say, euro yen, because pound yen had Bank of England, which can distort things. So let's take a look at euro yen. So yesterday, euro yen had a down day and stock market had a down day, right? So now I'm expecting, after the pin bar, which is our technical signal on the charts in S&P 500, I am expecting S&P 500 to drop. So I went short in the euro yen. Now, of course, you want to draw your support resistance lines and whatever other tools you're using. I use the pivot points. So I was looking for a pullback into daily pivot, and now prices into support, right? So this is where I would enter the trade. I'm looking at, essentially, I just take a look at, so I depend on my technicals to enter the trade to get a good entry, but then I look at overall what's going on in the market. So it was my, I don't want to say prediction, it was my forecast, or my um, educated guess, that S&P 500 would drop. So I took a trade in euro yen, but then I looked at the technicals before entering the trade. I hope that answered the question. Um, Can I show the slides again? You know what? I will do this. I will give the slides to Lily. Lily, if everybody wants the slides, please feel free to have them. I will just do a PDF of them, and you guys can have them, so you don't need to take a picture. Any other question? A quick recap, of course. Let's do that. Okay, so let's do a quick recap. The market correlations that we talked about today. So the first thing we talked about was interest rates. So right now, central banks are very important, but I feel like we are kind of a little bit past this, in the sense that they have already cut the rate. So when this whole pandemic started, we saw that central banks were cutting rates, and when rates are cut, that means the currency drops. When interest rates go up, the currency goes up. And this is why the carry trades exist. And the carry trades basically mean that you are taking a low yielding currency. That means the currency that doesn't pay a lot of interest, and then you are selling that and you're buying a currency that pays higher interest rates. In this case, we see that yen has negative interest rates. They have been at negative interest rates for years now. So it doesn't make sense to invest in putting money in the banks in Japan. So it would make more sense to borrow from Japan because the interest rates are so low, and then invest into, for example, buy Australian dollar. So you're going long Aussie yen. This is called a carry trade. So that's our interest rate. So money flows from the country that has lower interest rates into the country that has higher interest rate, which means the country that has higher interest rate will have a stronger currency. So that's our interest rates. Oil. Oil and Canadian dollar are directly related, and NOK as well. So Norwegian krona is directly related with oil as well, because both Norway and Canada are oil producing countries. So when oil goes up, Canadian dollar goes up. So there's a positive correlation between the two. Now, remember though that with dollar CAD here, US dollar is the base currency. That's why the relationship is opposite. So even though oil and Canadian dollar move in the same direction, dollar CAD will move in the opposite direction because US dollar is the base pair. So we see that when oil is going up, our dollar CAD goes down, and then when oil drops, dollar CAD goes up. So just remember, dollar CAD and oil are oppositely, they move in the opposite directions. Gold here, Aussie and gold, they tend to move in the same directions. Right now, just a caveat here, gold has been going back and forth with the stock market. So that one, I would say, watch it, right, before you start jumping into that one. But generally what happens is the relationship that tends to happen is when gold drops, Australian dollar drops. When gold goes up, Australian dollar will go up. So that's our gold. And this is straightforward positive correlation there. And then we have inverse correlation, which is between US dollar and gold. That's something to keep in mind over the next 6 months to a year, because gold is likely to go up. Stock market is something that is playing out right now, and this is something that can really help us today. That is, if the stock market moves up, Aussie dollar will move up, New Zealand dollar will move up, yen crosses will move up. So keep that in mind. And when the stock market is dropping, and if we really go into risk off mode, right now it's just stock market is soft. It's just waiting to see where it will go. So if that support line that I showed you, if that breaks, that means we're going into risk off mode. In that case, you will notice Aussie dollar will sell, New Zealand dollar will sell, and all the yen crosses will sell as well. So that is the relationship. And these are the pairs in terms of our Forex that are correlated. Euro and pound dollar both move in the same direction. And we see that yen crosses and Swiss crosses move in the same direction. And generally the US dollar, like Aussie dollar and New Zealand dollar, will move in the same direction as well. Any other questions here? Okay, so I think that brings us to the end. And I will wrap it up here. Before we wrap it up, just a reminder here that Vantage is offering lucky draw. So for $50 credit towards your trading account. And in order to participate in that, we will love some feedback from you guys. So please send out an email and rate this webinar from 1 to 5, 5 being the best. 1 needing a lot of improvement. Hopefully it is not 1, but please feel free to provide honest feedback, because that's what will help us improve these in the future. And then please provide a comment on one thing you loved about this webinar, and then also one thing that can be improved next time. So I do want to make sure that I deliver the very best education and information that I can. So please do provide some comments on how this can be improved. And For all of that, please email client success at vantagefx.com within 2 business days so that we are able to accumulate all the feedback and make the changes as needed based on the feedback. And of course, thank you very much for attending the webinar. I hope that you found this useful. If you want more information about me, please visit tradingwithvenus.com. I also have a YouTube channel where I provide daily market analysis as well as weekly market analysis. And that is, of course, free. You can just check it out. If you do a search for Trading with Venus, you'll be able to find my YouTube channel. And there are tons of videos like this that you will find on the YouTube channel as well. So Lily, back to you.
Right. Thank you very much for all this useful information. So as Rama mentioned, so for anyone who want the PDF version of this webinar or who want the record of the whole webinar, please email clientsuccess@vantagefx.com. In the next like 1 to 2 days, we'll be able to generate it and email that to you. And for anyone who want to participate in our $50 trading credit lucky draw, please do send the feedback to us. I can see some regulars here, so I think you guys all know the drill. Again, thank you very much for everyone. We will have another session with Roman next Tuesday, I believe is evening European time. So if you want to like to sort of revisit the whole webinar again, you are more than welcome to join us. Thank you very much, ladies and gentlemen, and have a good day. Thank you. Bye.
Bye.